So if you've ever entered a trade and it immediately went against you, took out your stop, and then went in a direction you predicted, then this is probably why. So it's this concept here called inducement, or also known as manipulation. And essentially all it is a fake out before the real move occurs. So in the last videos we spoke about structure, liquidity for value gaps, order blocks, and equilibrium. And now we're going to talk about something which ties all of it together, which is inducement, and that is why the markets often move against traders. So yeah, essentially in a nutshell, it is just a fake out before the real move occurs. But it's actually designed to get people in the wrong position. So instead of moving directly to the real target, it's a trap. The market creates a trap. So let's say we have a level of liquidity down here, and price is trading towards it, hits it, and then from here, now that your level has been hit, you'd start looking for a long. So let's say that price trades into a fair value gap within this level. You can place a long, target, whatever. And then from here, you would like to see price trade up and hit your take profit. However, usually that is not what happens. Price would never just go up like this. Instead, what it would do is come up and then come down one more time. And what that does is it stops all of these people here who had their stop loss down here aiming for an initial long. It stops them out straight away. And this is called an internal sweep. So this level here gets swept, and this leg here, which sweeps this internal level, that is called manipulation or inducement. This obviously doesn't always happen. Sometimes you can be looking for a long and price will come down into this level, straight away bounce and go up to whatever your level is. But a lot of the times it will fake you out first, manipulate lower, and then go higher. So the reason this happens is pretty simple. It's just simply because the market needs liquidity to move. So when people are placing their orders down here, the market can go up, take down these orders, gain some liquidity, and then get the strength to move higher. And obviously it's the same with the bearish example. But let's try and find an example on the chart. It shouldn't be that hard to find. It happens all the time. Okay, so for example, as you just saw here on the 5-minute, we have this swing low, which is a form of liquidity. If we go on to the 1-minute, as you can see, the swing low gets swept here by this candle. So what a lot of people would be looking to do here is when this has been swept and they see a nice candle reaction like this, that's it. They would go long on this candle, whatever, stop on the low and then target, whatever. And obviously it looks good, the liquidity's been swept, you've had a nice reaction, so you'd like to see price just trade up to your level. But again, in this scenario, it doesn't happen. Why doesn't that happen? Because price gets a nice reaction and then it goes down. It sweeps out that level again, and after sweeping that level out, that's when you get the real move higher. So you could enter on this candle, for example, in the inversion, and that would be the real trade. Obviously, like I said, this doesn't always happen, but if you really want to look for like those A+ setups, then an internal sweep is non-negotiable for me. It will drastically improve your win rate if you always wait for an internal sweep. Obviously, it can hinder your trades taken because you're going to be waiting a lot more, and sometimes price will just reverse without an internal sweep. But it's something that you definitely need to always bear it in mind. So if you connect this to the liquidity, which I taught about, as I said, price comes up, sweeps the internal liquidity here, gains the momentum, and then pushes up higher. So yeah, inducement isn't random, or manipulation isn't random, call it whatever you want. It's part of a larger sequence. So it takes liquidity and it moves into the real direction. So if you do take one thing away from this video, it's don't always trust the first move. It's often designed to pull you in. Be patient, wait for an internal sweep. If there is no internal sweep and price continues trading higher, there will be another entry most of the time. But in the next video, we'll start combining everything into a full model so you can actually use all of this in real-time trading.